Three separate systems broke historic levels in the same month. Surprised. The United States Treasury market recorded its largest foreign dumping event since 2008, with $94.3 billion in net sales across a single four-week window. Simultaneously, the U.S. commercial real estate debt wall hit its most concentrated maturity cluster in recorded history, $929 billion in loans coming due before December 31, 2026, against a refinancing market that is functionally closed for the asset class at current rates. And at the same moment, the share of global central bank reserves held in U.S. dollars dropped below 57% for the first time since the Bretton Woods system was dismantled in 1971. Pause. Three thresholds, 1 month, zero mainstream coverage connecting all three to the same underlying mechanism. We are going to fix that today. Every number sourced, every line of math explained. Drop one word in the comments. Prepared or worried? Curious. Today is Wednesday, March 11th, 2026. Gold is at $5,194 on the bid. The 10-year Treasury yield is sitting at 4.87%. The dollar index is at 98.4. And the spread between investment-grade corporate bonds and Treasuries just widened 34 basis points in a single week, the fastest single-week spread expansion since March 2020. That spread number is the one that ties everything together. By the time we finish, you will understand exactly why those 4 data points are not separate stories. They are one story. And the timeline attached to it is not a distant theoretical event. It is the next 90 days. Let me start with the Treasury market because what happened in the foreign holder data for January 2026 is the clearest snapshot of dollar confidence stress this cycle has produced. Japan reduced its Treasury holdings by $31.2 billion in a single month. That is not a portfolio rebalancing. Japan has been the largest foreign holder of U.S. government debt for most of the past 2 decades. A $31 billion single-month reduction from Japan alone is a signal, not noise. China reduced its holdings by $22.7 billion, bringing its total to $761 billion, the lowest level since 2009. China's peak Treasury holding was $1.317 trillion in 2013. They have now reduced exposure by 42% from that peak over 13 years. That is not a trade dispute response. That is a structural sovereign decision executed across multiple administrations with a clear directional commitment. Saudi Arabia, United Kingdom, and the Cayman Islands, which functions as a proxy holding vehicle for institutional and sovereign capital, collectively sold a net $40.4 billion across the same window. Total net foreign sales, $94.3 billion in 4 weeks. The buyer of last resort for that supply is the Federal Reserve, primary dealers, or domestic institutions. The Federal Reserve is not currently in an expansion phase. Primary dealers absorbed $61 billion of that supply. They funded that absorption through the repo market at rates that are now the highest since 2007. Domestic institutions, specifically pension funds and insurance companies, absorbed the remainder at yields that compress their mark-to-market equity positions simultaneously. This is a closed loop with no external relief valve. When foreign holders sell, domestic balance sheets absorb. When domestic balance sheets absorb at elevated yields, their existing fixed income portfolios decline in value. When portfolio values decline, their liability coverage ratios tighten. When coverage ratios tighten, their capacity to absorb the next round of foreign selling shrinks. This cycle has been running for 18 months. January 2026 was the first month the rate of foreign selling exceeded the rate of domestic absorption capacity without a yield spike large enough to attract emergency buying. The 10-year held below 5% only because primary dealers stepped into a gap that is not sustainable at their current balance sheet utilization rates. One persistent misreading of the Treasury market needs addressing before the commercial real estate data. People point to the TIC data and say foreign selling is offset by foreign buying of U.S. equities and corporate bonds. That is arithmetically true in aggregate and completely irrelevant to the specific mechanics of Treasury market functioning. The Treasury market is the collateral backbone of the entire global dollar system. A dollar held in Apple equity does not fund overnight repo. A dollar held in a private credit vehicle does not settle sovereign transactions. The substitution argument confuses gross dollar exposure with the specific systemic function that Treasury holdings perform. They are not interchangeable. The TIC offset argument will not rescue the primary dealer balance sheets that are currently absorbing what foreign sovereigns are selling. Which is why what is building in the commercial real estate maturity wall is the number that makes every Treasury signal urgent. $929 billion in commercial real estate loans mature before December 31st, 2026. That number requires context to carry its full weight. The total outstanding commercial real estate debt in the United States is approximately $5.8 trillion. Of that $5.8 trillion, $929 billion, 16% of the entire stack, matures in a single calendar year. The loans inside that maturity wall were originated primarily between 2019 and 2021, when the 10-year Treasury yield averaged 1.4%. They are refinancing into a market where the equivalent benchmark is sitting at 4.87%. The interest rate differential alone on a 10-year refinancing at current rates versus origination rates represents a 248% increase in annual debt service cost per dollar of loan balance. Run the scenarios. Office properties. Vacancy rates in major metropolitan office markets are averaging 22.3% nationally, with San Francisco at 36.1%, Chicago at 29.4%, and New York at 21.8%. A property that was underwritten at 8% vacancy in 2020 is now carrying 3 to 4 times that vacancy rate. Net operating income, the numerator in every commercial real estate valuation, has collapsed. The denominator, the capitalization rate, has expanded as interest rates rose. Value destruction comes from both directions simultaneously. Loan-to-value ratios that were originated at 65% are sitting at effective loan-to-values of 95 to 110% today on properties that cannot service their debt at refinancing rates. Multifamily properties. The narrative through 2023 was that multifamily would be the safe sector. Rents rising, occupancy stable, demand structural. That narrative broke in 2024 when new supply deliveries, construction starts from the 2021 and 2022 building boom, hit markets simultaneously in the Sun Belt. Phoenix, Austin, Nashville, and Charlotte are all showing rent declines of 8 to 14% year over year against operating cost structures that were built on 2021 projections. Multifamily loans maturing in 2026 face the same rate differential problem as office, with the additional pressure of a rent environment that moved in the wrong direction at the wrong time. Retail and industrial. Industrial held through 2024 on the strength of e-commerce fulfillment demand. Cap rate expansion has now hit industrial as well. The 10-year move from 1.4 to 4.87% does not exempt any property type from valuation math. Retail, already under structural pressure from e-commerce displacement, is seeing a second wave of anchor tenant closures in 2026 that is triggering co-tenancy clauses and accelerating vacancy in strip and regional mall formats. $929 billion in maturities. Approximately $380 billion of that total, the JP Morgan research team published this number in February, is estimated to be unable to refinance at current rates without an equity injection or negotiated extension. A $380 billion refinancing gap against a lending market where regional banks, who hold approximately 70% of commercial real estate debt, are simultaneously managing deposit outflows, unrealized bond losses from the 2022 to 2023 rate cycle, and the private credit gating contagion from the BlackRock, Blackstone, and Blue Owl events last week. These are not separate problems. They share the same source. The same rate environment that impaired regional bank bond portfolios in 2022 and 2023 is the same rate environment that made $380 billion of commercial real estate effectively non-refinanceable in 2026. Same cause, different channels, same destination. And while that maturity wall is building on the credit side, the reserve currency signal from the same month crossed its own historic threshold. The IMF published its Q4 2025 currency composition of official foreign exchange reserves data in February 2026. U.S. dollar share of global reserves, 56.8%, below 57% for the first time since 1971. To understand why that specific level carries the weight it does, you need the structural context. At the peak of dollar reserve dominance in 2001, the U.S. dollar represented 72.7% of global central bank reserves. The decline to 56.8% has occurred across 25 years and multiple reserve currency shifts. The euro captured share from 1999 to 2010, then stalled. The renminbi captured share from 2016 onward, now at 2.8% of global reserves. But the most important shift in the current data is not which currency is gaining. It is which asset class is gaining. Gold. Central bank gold purchases in 2024 totaled 1,045 tons, the third consecutive year above 1,000 tons after 15 years of averaging below 500 tons annually. In 2025, that figure accelerated to 1,144 tons. The buyers are not the traditional Western central banks. The buyers are the central banks of countries that have watched what happened to Russian foreign reserves in February 2022 when $300 billion of dollar-denominated Russian sovereign assets were frozen by executive order of the United States Treasury without a judicial process. Every central bank that observed that event recalibrated its reserve model against one specific question. If dollar reserves can be administratively frozen, what is the cost of holding fewer of them? The answer is now 25 consecutive months of net central bank gold purchases above 80 tons per month with no reversal signal in the positioning data. The dollar reserve share does not drop from 72.7 to 56.8% in isolation. It drops because the institutions managing the largest pools of sovereign capital in the world are making a directional decision, slowly, consistently, and in one direction. Here is the direct connection between all three signals. Foreign sovereigns selling treasuries are not converting those proceeds into euros or yen at comparable rates. They are diversifying into gold, into bilateral currency arrangements, and into domestic infrastructure investment. That is why the dollar reserve share is falling and treasury selling is accelerating simultaneously. They are the same transaction expressed in two different data series. The commercial real estate maturity wall creates a bank stress event at the regional level at precisely the moment when regional banks are least equipped to absorb it. Regional banks are 70% of commercial real estate lending. They hold approximately $2.1 trillion of that $5.8 trillion total stack. They are simultaneously managing unrealized securities losses from the rate cycle, deposit competition from money market funds paying 4.9%, the private credit contagion question of which regional banks lent into the BlackRock, Blackstone, and Blue Owl vehicles, and now $929 billion of commercial real estate maturities with a $380 billion refinancing gap arriving before December 31st. The Federal Reserve's room to cut rates to relieve that pressure is constrained by a dollar that is at 98.4 on the index and a reserve share that just broke below 57%. Cutting rates into a dollar that is already losing reserve share, at a moment when foreign sovereigns are actively reducing treasury exposure, risks a disorderly dollar move that makes the commercial real estate problem worse by triggering capital flight rather than investment. Monetary paralysis. The same structure we identified in the silver analysis. The Fed cannot tighten because credit is already breaking. The Fed cannot ease because the dollar cannot absorb the signal. The window between those two constraints is narrowing on a timeline measured in quarters, not years. Let me put the complete picture on one table for this single moment in time. Foreign treasury sales, $94.3 billion net in 4 weeks. Japan, minus $31.2 billion. China at $761 billion, lowest since 2009, down 42% from peak. Dollar reserve share, 56.8%, below 57% for the first time since 1971. Central bank gold purchases, 1,144 tons in 2025, third consecutive year above 1,000 tons. Commercial real estate maturities due 2026, $929 billion total, approximately $380 billion estimated non-refinanceable at current rates. Regional bank CRE exposure, approximately $2.1 trillion against institutions already managing unrealized bond losses and deposit competition. Investment-grade credit spread widening, 34 basis points in a single week, fastest since March 2020. Gold price, $5,194. 10-year Treasury yield, 4.87%. Dollar index, 98.4. 4 independent systems, 1 convergence point, 1 timeline. The Treasury market was absorbing foreign selling because domestic institutions had balance sheet capacity to step in. That capacity is now visibly at its limit. Primary dealer repo utilization is at levels last seen in 2007. The commercial real estate wall arrives before year-end 2026. The regional banks holding the majority of that debt are operating without the rate relief that would make extensions and modifications arithmetically workable. The dollar's reserve share has crossed a psychological threshold that the central banks of every emerging market economy are watching in real time. The question is not whether these systems are stressed. Every number in this video confirms they are. The question is what forces the paper price of safety assets to reconnect with the physical and structural reality of what these systems are communicating. The answer is not a single event on a single date the way the COMEX first notice day creates a binary forced decision. The answer here is a sequence. The first forced decision point is the commercial real estate maturity wave hitting in Q2 2026, specifically April through June, when the largest single quarterly cluster of 2026 maturities comes due, approximately $241 billion in that 90-day window. When extensions are requested, denied, or converted to distressed sales, the regional bank capital adequacy question becomes a regulatory event, not a market sentiment event. Regulators move. FDIC loss estimates get published. The numbers in those publications will not be measured in billions. They will be measured in hundreds of billions. At that moment, the investor who holds an asset that carries zero counterparty risk, cannot be gated, has no redemption cap, and is globally liquid against a system that is simultaneously gating private credit vehicles, managing bank stress, watching dollar reserve share fall, and absorbing $94 billion in foreign treasury sales per month. That investor is not making a speculative decision. They are making the only logical decision available to them. Gold at 5,194 is not priced for a 56.8% dollar reserve share continuing its 25-year directional decline. Gold at 5,194 is not priced for $380 billion of non-refinanceable commercial real estate debt arriving inside a 9-month window against undercapitalized regional banks. Gold at $594 is not priced for $94.3 billion monthly foreign treasury sales at a moment of Federal Reserve monetary paralysis. The paper price and the structural reality are not connected right now. They were not connected before March 2020 either. The reconnection in March 2020 happened in 11 trading days. One word in the comments. Prepared or worried? If you understand what $380 billion of non-refinanceable debt arriving against regional banks already managing unrealized losses means alongside a dollar reserve share that just crossed below 57% for the first time since 1971, subscribe if you are not already. Every number in this video is sourced and verified. This is the Finance Channel.